In this video, we'll cover the accounting cycle for merchandisers, along with the multi-step income statement and closing entries. This video will retread some of the ground covered in my video on the closing process for a service company. If you didn't watch that video, don't fret. I'll cover everything you need to know. I should also note that this video covers the aforementioned items for merchandisers who use the gross method for accounting for merchandise inventory purchases and sales. If your course is using the net method, I suggest you watch video 9A instead of this one. Let's do a high-level summary first. The accounting cycle is the series of tasks performed by the accountants every month. Depending on your textbook, the cycle may consist of as few as 6 steps or as many as 10, depending on whether any are combined or separated. But the general process is as follows. First, we record journal entries and post them to the ledger throughout the month as the transactions occur. Purchase supplies, record and post. Make a sale, record and post. Pay off a liability, have some equipment repaired, collect a receivable, record the journal entries and post to the ledger. Once we arrive at the end of the period, we then prepare the trial balance. This is a check to make sure total debits equals total credits. If the two do not balance, we know we have an error that must be corrected before proceeding. Next, we record and post our adjusting journal entries. Remember, these are the transactions that we didn't necessarily receive a source document telling us to do anything. Expensing prepaid assets like prepaid rent or prepaid insurance, accruing expenses or revenues, adjusting unearned revenues. These are our adjusting entries that must be recorded to ensure that our records are as accurate as possible as of the end of the period. Once the adjusting process is complete, we prepare another trial balance, commonly called the adjusted trial balance. Note that the previous trial balance is correspondingly referred to as the unadjusted trial balance. The purpose of the adjusted trial balance is the same as the first one. Verify that total debits equals total credits. If they don't balance, we know we have an error that must be rectified. Furthermore, if debits don't tie to credits on this trial balance, but they did on the previous one, we know that the error occurred somewhere in the adjusting process. If we neglected to build the unadjusted trial balance, we'd have no idea where that error occurred. It could have happened all the way back with the first journal entry in step 1. Building these trial balances offers a quick way to isolate where any mistakes may have occurred, and hopefully quickly identify and rectify them. Next, we build the financial statements, namely the income statement, the statement of owner's equity, the balance sheet, and as we'll eventually cover, the statement of cash flows. After building our financial statements, we record and post our closing entries. These entries will move our revenues and expenses into our owner's equity. We'll talk more about these entries momentarily. Finally, we prepare our post-close trial balance. Just like the others, this trial balance verifies that total debits equals total credits. And we repeat the cycle afresh next period. If these steps seem like a lot to remember, you only have to remember steps 1, 3, 5, and 6. After that, just remember that after recording and posting any journal entries, you do a trial balance to ensure that total debits equals total credits. For the purpose of this example, let's imagine we've already recorded and posted our journal entries as they occurred during the month. Consequently, we pick up this process in our accounting cycle with step 2. At this point, we've already recorded our journal entries for the transactions that occurred throughout the month. Once we finish with the last of those journal entries, we prepare our first trial balance, or the unadjusted trial balance. This worksheet simply shows each account with its respective debit or credit balance. At the bottom, we see that total debits equals total credits. This reconciliation doesn't guarantee that everything is right. For example, imagine we make a cash purchase of supplies. But instead of debiting it into supplies, we debit it into merchandise inventory. Total debits will still equal total credits, but 1,000 of our debits are in the wrong account. However, if total debits does not equal total credits, we know for certain that something is amiss. Since we're in balance in this example, we can proceed to the next step. Next, we prepare our adjusting entries. Of course, we record these entries as I discussed in video 5. Let's imagine that we have the following adjustments. First, we'll record depreciation expense on store and office equipment in the amounts of $1,100 and $900 respectively. We'll also accrue sales and office salaries expense in the amounts of $40,800 and $61,200 respectively. Finally, we earn a portion of advanced customer payments, or unearned revenue, in the amount of $7,000. Once we've finished recording and posting our adjusting entries, we prepare our adjusted trial balance. Again, we need to make sure that total debits equals total credits before proceeding. We'll update this spreadsheet based upon the previously prepared adjusting entries. First, we post the debits and credits from our depreciation adjusting entries. If you're a bit flummoxed how these adjusted balances are determined, just build a T account. Consider depreciation expense on office equipment. We have a debit balance of $17,100. And we just posted a debit of $900. Consequently, the new adjusted balance is $18,000. We'll do the same for accrued employee expenses and unearned revenue. Take a moment to notice the impact of these debits and credits on this sheet. Office and sales salaries had debit balances in the unadjusted columns. The debits from the adjusting entries gave us increased debits in the adjusted column. As for unearned revenue, that account had an unadjusted credit balance. So the debit from the adjustment lowers that credit balance. Again, if you don't quite follow how this works, just build a T account. All the other accounts that weren't adjusted will keep their unadjusted balances. You can observe that these accounts, like cash and accounts receivable, have the same adjusted balance as unadjusted balance. Finally, we do our sanity check and verify that total debits equals total credits for both our adjustments and our adjusted balances. Next, we build our financial statements. We prepare our financial statements in the same order as previously discussed. However, the income statement we observed in the previous video was a single-step income statement. That one was very simple. We simply listed all revenues and summed them, did the same for expenses, and took the difference between total revenues and total expenses to arrive at net income. That method is sufficient for small service companies, but merchandisers prefer an income statement that provides a little more information. This is what's known as a multi-step income statement. All the revenue and expense items from our chart of accounts will show up here, but they'll be grouped differently than on a single-step income statement. Let's consider R&F Bicycle's multi-step income statement. First, we determine net sales. We do so by listing our revenue accounts, then subtracting sales discounts and sales returns and allowances. Remember that our revenue accounts are credits, but sales discounts and sales R&A are contra-revenue accounts, so their balances are debits. Consequently, the debits will net against our credits, and the difference is our net sales. Next, we subtract out cost of goods sold to arrive at gross profit. Cost of goods sold is almost always the most significant expense of a merchandiser. It's the cost that consumes most of the revenue, so we subtract it first. The resulting difference, gross profit, tells us how much money we have left to cover all remaining expenses. Next, we have our operating expenses. Most of our expenses will be conveyed here. These are those costs we incur in the actual running of the business. Within operating expenses, companies typically further divvy them up by sales and marketing and general and administrative expenses. Sales and marketing are those expenses incurred for the purpose of generating revenues. What we pay our sales staff, depreciation on store equipment, rent on our retail space, and advertising are all common examples. G&A are basically those expenses that don't directly generate revenue, but they're essential for running a business nonetheless. For example, what we pay our office employees. The jobs of accountants, HR managers, or IT technicians don't directly result in customers making purchases, but the business won't function very well without them. Similarly, depreciation on office equipment, rent on the office space, and office supplies are all related to G&A expenses. Another way of thinking about these two subcategories is that those expenses that occur in a retail space are sales and marketing, and those that occur in the corporate office are G&A. Then we sum all of our operating expenses and subtract that amount from gross profit to arrive at income from operations. This is just what it sounds like. How much money did we earn through conducting our business activities? Next, we list our other revenues and expenses. This section is kind of like the junk drawer for the income statement. Expenses and revenues that don't neatly fit into sales and marketing or general and administrative expenses go here. Most commonly, interest expense on borrowings or interest or dividend revenue from the business's own investments show up here. We combine this amount with income from operations to arrive at income before taxes. Deduct the income tax expense, and we're left with net income. I know this looks like a lot, but you just have to memorize the process. Sales minus cost of goods sold equals gross profit. Subtract operating expenses from gross profit to get income from operations. Remember that operating expenses contains both S&M as well as G&A. Subtract or add other revenues and expenses to get income before taxes. Then subtract out income tax to arrive at net income. I've never been able to come up with a handy mnemonic for this item. If you have one, please leave it in the comments. The rest of financial statements are prepared as usual. The statement of owner's equity will take the beginning owner's capital balance, add in any contributions as well as net income, then subtract out drawings to arrive at the ending owner's capital balance. Same again for the balance sheet. We start with our assets. Within our assets, we list our current assets and our PP&E, or plant, property, and equipment. We subtotal our current assets, as well as our non-current assets, or just PP&E in this case, and we arrive at total assets. We do the same for our liabilities. Our liabilities will have our current liabilities, as well as our long-term liabilities. Subtotal our current liabilities, and if we had more than one long-term liability, we would do the same thing. In this example, we just have one, so we can just list that balance. Sum them up, and we have total liabilities. Our owner's equity will consist of owner's capital, and we pull this balance from the statement of owner's equity. specifically the ending owner's capital balance. Add our total liabilities to our owner's capital, and we arrive at total liabilities plus equity, which should match total assets. Next, we record and post our closing entries. Before we talk about the actual closing entries, we need to distinguish between permanent or real accounts and temporary or nominal accounts. Permanent accounts retain their balances from one period to the next. In other words, their balances are literally permanent. Our permanent accounts consist of our balance sheet accounts. As an example, think of the cash account. If you have $10,000 in your cash account on 11:59 p.m. of December 31st, how much cash do you have as soon as the time rolls over to 12 a.m. on January 1st? It's $10,000, right? You can apply the same reasoning to just about any item on the balance sheet. If you have an account payable balance of $1,000 on December 31st, you still owe that amount the next day on January 1st, right? Your debtor doesn't wipe away your obligation just because the new year arrived. These characteristics are the opposite of our temporary accounts, whereas permanent accounts keep their balances from one year to the next. Temporary accounts are reset to zero right before the start of the new year. Our income statement accounts, like revenues and expenses, as well as drawings, are our temporary accounts. To understand why we reset them to zero, consider what would happen if we didn't. Imagine we have $1 million in revenues sitting in our sales account. Now, imagine we earn $1 million in revenue every year for the next 4 years. Our account would tell us that we have $5 million in revenues. But putting that balance on the income statement wouldn't provide any indication as to how much money we've earned in the current year. Do that for enough years, and we might have $1 billion in revenues, but we'd have no idea how well we performed in the current year. That's why we reset the balance to zero right before the new year starts. Looking back at our adjusted trial balance, our temporary accounts are all conveniently grouped together, specifically drawings, revenues, and expenses. How can we zero them out? With a journal entry. Let's start with our income statement accounts. Our revenues have credit balances, so if we want to move them to zero, we'll have to debit them. As for our contra revenue accounts, they have debits, so we'll close them out with credits. Our expense accounts will be treated in the same way. They currently have debit balances, so we'll need to credit them for those amounts. At this point, if we sum our total debits and credits for this journal entry, we'll find that we're out of balance. Specifically, we'll need a $473,850 credit to make both columns tie. If this number looks familiar, it should, because it's our net income. We have all our revenues in our debit column and all of our expenses in our credit columns. So what's the difference between revenues and expenses? Net income, of course. This credit will go to our owner's capital account. Effectively, we've transferred all of our revenue and expense account balances into owner's capital. Picture the T accounts for our revenue and contra-revenue accounts. They have their respective debit and credit balances prior to this entry. The debits to fees earned and sales of merchandise reset them to zero. Similarly, the credits to sales discounts and sales returns and allowances reset those accounts to zero. The same result can be observed with our expense accounts. They all have debit balances, so credits to them from our closing entry will reset each one to zero. Once we've closed out our income statement accounts, it's time to do the same for drawings. Again, if we didn't, we'd eventually have a huge balance in it with no idea how much the owner had withdrawn during the year. Right now, we have an adjusted debit balance of $353,750. To clear it out, we'll credit drawings and debit owner's capital, so the credit from our journal entry moves the drawings account balance to zero. Let's consider the impact of these entries on the owner's capital account. Here we have our previous two closing entries. I've changed their colors in order to help you distinguish them from one another. With each of these entries, we booked an amount to owner's capital. If you look back at the adjusted trial balance, you'll see that the current balance is a $2,109,900 credit. We can depict this balance as a T account seen here. We then post the credit from the income statement closing entry and the debit from the drawing closing entry. Our new balance becomes a $2,230,000 credit. Hopefully, that new balance looks familiar. It's our ending owner's capital balance from our statement of owner's equity. As of the posting of our closing entries, our owner's capital account should align with the statement of owner's equity. Consider what we did on the financial statement. We began with our beginning year balance. We added in contributions plus net income, subtracted out drawings, and arrived at our year-end owner's capital balance. You can see the exact same thing happening within the T account. We start with our beginning year balance. We add in net income. If we had contributions, we would also have it here in the credit column. And we subtract out our drawings. The ending credit balance is our year-end owner's capital balance. My point being, our closing entries will adjust owner's capital to the ending balance from the statement of owner's equity. If that's not the case, there's an error somewhere. Let's talk more about these closing entries. Consider this separate example independent from R&F bicycles. We have the following balances in revenues, expenses, owner's drawings, and owner's capital. The general process we just saw was to first debit revenues and credit expenses for their respective balances and plug the difference to owner's capital. The debit from revenues will reset that account to zero. The credit to expenses will do the same, and owner's capital will increase by an amount equal to that year's net income. We then close out our drawings with a credit and debit its balance into owner's capital. We post to our ledger accounts, and drawings returns to zero, and owner's capital arrives at an ending balance of $75,000. There are other ways you can close out these accounts, and depending on which text your course is using, you may see the entries performed in a different manner. Note that while the process may be slightly different, you'll always arrive at the same result. Allow me to show you one such alternative entry in the bottom left corner of your screen. I've included the previous closing entry in red so you can observe how this one is different, yet it yields the same result. Under this method, you could close out your revenues and expenses separately. Here, we debit revenues for its balance and credit owner's capital. Next, we credit expenses for its balance and debit owner's capital. Look at the result of posting these journal entries to their ledgers. The net effect of the debit and credit to owner's capital is a net credit of $60,000. The exact same amount as in our previous example. In both instances, we credited owner's capital for the value of the year's net income. Afterwards, we close out drawings just as we did previously. When all is said and done, we have an ending credit balance of $75,000 in owner's capital, exactly as in the previous example. One more way you may see the closing entries booked, depending on your course, may involve an account called Income Summary. Again, I've included the previous style of closing entry for comparison in red. This method is almost identical to the previous one, save for the new account. We'll close out our revenues and our expenses individually, but we'll initially move their balances to the Income Summary account. In other words, debit revenues and credit income summary for $100,000, bringing revenues to zero. Next, debit income summary and credit expenses for $40,000, bringing expenses to zero. Income summary comes to a $60,000 credit balance. At this point, Income Summary has a credit balance equal to the company's net income. This means that no revenue or expense account has been overlooked, so we can close Income Summary to owner's capital. Close out drawings just as we've done in every other example. Owner's owner's capital will have an ending balance equal to the year-end balance on the statement of owner's equity. Finally, we prepare and post our post-close trial balance. Here we see the ultimate impact of those closing entries. That is, revenues, expenses, and drawings are all reset to zero for the upcoming year. And owner's capital has the ending balances from the statement of owner's equity. Again, all the balances from our temporary accounts have been moved into the balance in owner's capital. Only our permanent accounts have balances going into the new year, and the ending owner's capital balance matches the calculated amount from the statement of owner's equity. We can also verify that total debits equals total credits after our closing entries. If they don't, an error needs to be identified and corrected. That completes our accounting cycle. With the arrival of next year, the entire process will repeat itself. That concludes this video on the accounting cycle. The next video will address how to post to ledger accounts in manual systems. As usual, thank you very much for watching. If my videos are helping you and you want to return the favor, you can leave a thumbs up. If you have any questions or suggestions for how I can improve, leave them in the comments below. If you really want to help, temporarily subscribe to my channel. Not forever, just for however long you're taking your accounting course or courses. Finally, share my videos with your classmates and perhaps your professor. I'd like my videos to help as many students as possible, and I wouldn't mind getting some input from contemporaries. Thank you once again, and I'll see you in the next one.